Hey everybody, good afternoon. Should be up on YouTube as well. Hopefully it's running properly. What's up? What's up? What's up? What's up, Elliot? Hello, Joanna. What's up, Bill? Bandit? Dave S. What's happening, Rose? Tate? Good to see you, Eddie and Eddie. What's up, Tom? Ben? What's up, everybody? Pretty wild day. Um, Again, often a slow week on Wall Street. Not so slow today. But I'm not allowed to talk about it until I read this disclosure. What's up, Mario? So let's do that. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. I got in and out of a few names today. Amazon, Pins, AI. The only update on the disclosure since I last did an afternoon meeting 2 days ago is Apple. Bought real small Apple yesterday, kept a tiny bit of it, and then got a good bit heavier today, pre-market and at the open. Let's talk about some stocks. Let's talk about the stock market. Um, so what we discussed in the morning meeting was that today was really a do or die day for the bulls in a lot of ways. Spies closed down 0.3% and pretty much closed right at the key 445 level that I was saying we really need to close above in order for bulls to maintain some degree of control. Qs down 0.75%. They also made a decent intraday comeback. The daily chart's not broken. We can look at that in a second. IWM couldn't really do it though. Russell closing down 0.9%. We've had very consistent relative weakness in the IWM for the last several trading sessions. I really wanted to close above 185 in the IWM for bulls to kind of hold firm, and they couldn't do that. So depending on which index you're looking at here, you could say that the bulls are kind of holding on to some short-term bullishness by a thread, or if you're strictly looking at the IWM, they're not. So let's take a look at these daily charts as we have another red day on Wall Street, but we did close off of our lows. Intraday is not really too much to talk about. You know, we came in this morning with a game plan that today was a gap down into some support levels and that the gap down was large. So the main gist of this morning's game plan was to look long off the open, but really pay attention to your opening low. And if we lose the opening low in any real way post 10:15 to 10:30, that it could create bigger problems and we could get a continuation of our downtrend, which really started yesterday. Um, and it would also have some bigger picture daily chart repercussions. So that was a good opening game plan, right? We had that opening bounce to help satisfy the extension. That was the I always call this the easy part of the bounce, the easy move, even though we know in reality it's not necessarily easy. Sometimes the execution can be difficult. But taking advantage of a large common gap to the downside into some support on like a arguably day three to the downside, even though we aren't that extended in the market, big picture to the downside, is a pretty good trade. But if we lost that opening low, it could be a concern. And the spies actually ticked below the opening low to shake some people out. I know the Qs did not do that off their opening low, and the IWM is a little bit of a different story because it traded down right away and gapped down less than the other indices did. But the spies actually, faked some people out here with a little stop loss shakeout of that opening low before actually giving a pretty big rip. So little shake and bake here. But for the most part, the market held that opening low. Never really, ticked below it, never held below it, and the market was able to recover somewhat intraday. So again, we had our initial opening move. If you're long the spies themselves, you might have gotten shaken out. But a lot of the stocks that we were looking at did not break that opening low, and you may have gotten a decent close in some of them. I know like the Amazon turnaround, the Google turnaround in particular were pretty phenomenal. Going over to the daily chart though, we said that this positive Maribozu low from August 29th, which is 442.46, was like a major line in the sand. And if we got below 442.46 on a closing basis for the SPYs, then you can't make the argument that this market is short-term bullish anymore at all. And the way that I've been describing the market ever since we put in this little higher low, higher high, the higher low coming in on August 25th, the higher high coming in on the positive Maribozu, is neutral to bullish on the small time frame, right? So I love playing that. I call it the bullish bearish neutral game, where you try to assess the market trend, the market technicals on a small time frame, which for me is about 1 month, a intermediate time frame, which is more like a quarter, and a large time frame, which is more like a year. And then if you have all those time frames line up, well, then it's pretty simple. If everything's lining up to the upside, you'd rather be long than short. If everything's lining up to the downside, you'd rather be short than long. That obviously would assume everything else is held equal. Nothing else is ever held equal in reality. So we also want to pay attention to our extension rules, because sometimes you might have, a downtrend on every single time frame, but you're hitting a point of extension where it makes sense to come in on the other side of the market. But broadly speaking, that I think that bullish bearish neutral game is a great game to play, just to give you an understanding of how you should be broadly positioning yourself in the market, and what you can expect from the market as a whole, which we know is one of the most important layers of probability for any individual trades that you might take on any time frame. So our big picture here is certainly still intact and is bullish. The intermediate picture I keep saying is neutral, and the small picture again I had described it as going from bearish to neutral to bullish, maybe not outright bullish, based on this little higher low, higher high that we had. But you don't want this market to really lose that positive Maribozu low from the jolts environment and kind of get back into this range, because it would be very difficult to make the argument at that point that we are shorter time frame with like a 1 month look back bullish if we were to pull back that deep. And ideally you want the close above 445. 445 is becoming a major inflection point for the SPY. You can see it was big resistance back in June and the beginning of July. They held it as support in the beginning of August. They held it as resistance on the first test of it back up on August 24th. And now we've, finally really cleared back above it. You want to see that hold as support again. So we traded below that yesterday, but closed above. We gapped below that yesterday. We gapped below yesterday's low as well this morning. So it's a potential little kind of like day 3, day 4 RDR in the SPYs here. But you really want that close above 445 to be giving you more of that all clear sign that the bulls are maintaining some sort of short-term control. And again, we pretty much closed right at it. We closed like 10 cents off that 445. So it's pretty hard to analyze, I think, the SPYs here to say, did the bulls really come in and take the stand that they needed to and recapture and regain control, or not? So let's see how this market's able to perform tomorrow, and let's see how we're able to end the week, because the S&P is certainly a little bit precarious. We've discussed the reasons why this dollar move is really becoming a problem. The strength in the dollar, it's been so consistent. It's been holding up so well, even for most of today's trading session. I know that UUP ETF here closed a little bit off highs, but that is a continued tightening impulse. The TLT has improved a little bit, has improved marginally over the course of the last couple of days, but not to such a degree where it's giving us any sort of all clear sign. If anything, it's just kind of digesting in a bearish manner. If we can get this TLT back above 95, probably more ideally 96, that might help out the market a little bit. But for the moment, even though we had a positive day here, I would say that this TLT is still also a potential problem. So we've got the dollar certainly not working for us, at least right now. We got interest rates not really working for us either, though maybe provided a little bit of relief on today's trading session. It still has some work to do. Our SPYs are in a pretty precarious spot, closing right at this 445. Again, I think we need a little more data here. See how we close out the week tomorrow. The Qs are holding in just fine despite Apple, so the Qs are still pretty pretty decently far away from that August 29th positive Maribozu low from the JOLTS report, which is 366.23. Um, so yeah, so not too bad there. They recovered decently. I mean, ideally you want to see these Qs get back above 375. This is not the end of the world. The IWM is a much bigger problem. Couldn't recapture 185 on an intraday basis. Did actually trade below and I believe close at or just below the JOLTS August 29th low, which is 184.57. And they've certainly overshot what a healthy pullback would look like if this thing wanted to create another higher low and work its way up. So the IWM is really the big problem right now. It needs to provide some degree of recovery. It's really struggling to be able to do that. So we once again find ourselves in this market environment where it's like you look at the SPYs, yeah, hard to say. You look at the Qs and you're like, okay, this isn't too bad. And you look at the IWM and you're like, oof, this is a little bit of a problem. So I would say pretty broadly, we've got mixed signals from the market. Uh, IWM weakness always concerns me the most because of how often we've seen it be a leader over the course of the last almost 2 years now, really since November of 2021 is where I first have noticed, major IWM leadership that it tends to be whichever direction the IWM moves that the rest of the market follows. There have been a few exceptions to that over the course of the last couple of years, but it's been a pretty good general rule. So, I think we're kind of in wait and see mode on this market because I still think, and I've been saying this for well over a week now, that, big picture, a range bound market makes most sense to me. You know, for the next, I don't know, month plus. I don't really see us getting back above 460 in the SPYs and making new year highs anytime soon. I think if that does happen, it happens into the end of the year. But I still also think that, a major breakdown, a retest of like the 200 day or a test of that 4200 SPX breakout that was such a huge level that we broke out from back in May, early June. I still think that that's a lower probability event as well. So I think that the highest probability event is basically range bound action. With that said, I have to keep in the back of my mind that the lower probability situation of a breakdown, if that were to come to place, it probably happens very, very quickly, especially if you just kind of look at positioning in the market right now and what could happen if volatility really increases and the VIX really increases. Again, I still think it's a lower probability situation, but we need to be prepared that if that lower probability situation were to occur, it's probably going to happen pretty fast and pretty furious. I'm sure people remember what those bear market moves looked like back in 2022. And we're obviously not in a bear market right now, but it doesn't mean that you can't get a sell off. And we know that markets, just in general, tend to move down much faster than they move up. I would also encourage everyone to take a look at the link that I posted to the VTF earlier. Which is a kind of a podcast or interview with Jim Carson, who talks a lot about a lot of stuff that we're looking at and dissecting as far as market dynamics go, which just have a really large impact on markets overall. So really worth it to pay attention to. I think the things that he's saying and to work towards understanding some of the things that he's saying because sometimes honestly it goes a little bit above my head, but that podcast was pretty good at breaking things down. And don't be afraid to pause on something if he's saying something you don't understand and do some of your own research on the side. I know that's what I do. Um, so yeah, so we'll see how this market plays out. Technically we're a little bit precarious here, but still kind of holding in. I still think big picture a range is the highest probability situation, which unfortunately is the worst situation from a trading perspective, right? If we work our way back up to 460, it probably would be in more of a grindy uptrend fashion. I'm fine with that. We can trade that. Our breakouts worked great. Like breakout trades worked great back in June and July for a couple of months there. It was a really easy period if you're a momentum or trend following trader to be able to make some money. So I wouldn't mind that at all if we worked our way back to highs and we kind of resumed a big picture trend. I also think that a heavy breakdown in the market where you get a fast move, that which is I think also a lower probability situation, down to a 420 or so, would also be great from a trading perspective. We could take advantage of those really big fast moves both to the short side for trend following, but then that's when we also get those big extension opportunities sometimes that come into play, a little bit similar to what we had at the low in August. We have not had a lot of those plays. They're some of my favorite in the market. 2022 was a difficult year, but I know that I was able to make all of my money basically off those types of plays when we would have those big bear market sell-offs and hit that $10 plus of extension, and then there'd be blood on the streets and fear everywhere, and we'd come in on the other side of the market. So that would probably make a good trading environment as well. But the range bound stuff becomes a little bit trickier, a little bit more difficult. But we had spent some time back in April and May when we were in a range, though I think that this range that we're in right now is a little bit more volatile, at least on a close to close basis than what we saw in April and May. But we did talk at that time about some strategies that we can also use to be able to make money in those more difficult range bound environments where you kind of have that core position on that you were able to get from a good price, and that you kind of work some of those cash flow strategies of selling the pops, rebuying the dips, and just kind of doing it over and over and over again to continuously put some cash in your pocket while you wait for the market to potentially break out or break down. So then I know that that's a lot of what I've been doing over the course of the last couple weeks or so, ever since we basically bottomed on August 17th. I've been, building out of the shorts into the moves higher, sorry, into the longs into the moves higher, building back into them in the moves lower, and I'm going to continue to do that until we get a broader technical signal on which way we actually break here or not. So, yeah, we'll see how that plays out. I was a little nervous this morning because I thought, the Bulls could lose this, and for the moment, at least, they're, I think, holding on by a thread. So that's big picture from the market. Small picture, I thought that today was a pretty good day, honestly, from a trading perspective. Maybe some of the executions were difficult, but there was a lot of good opportunity out there. We had discussed Google 133. That was one of the better trades that I had myself, below the day's 132.95. We had discussed in the morning meeting the importance of this 133 level that Google had broken out from. We got a retest of it just because of the market weakness. Low of the day's 132.95. Was able to buy stock at 133.01. So that was a pretty solid trade there. Amazon was also, talking about stocks where we're buying early in the beginning of the day because of the gap down in the market, just to see how these stocks and how the market itself handles the downside extension from the gap. I mean, this Amazon was another, really solid one to take advantage of. I was kind of buying that one down. I mean, even Apple, which was scarier and more difficult because this one is kind of subject to news. I was buying stock at 174, 174.50, both pre-market and after the open, and we're able to get a nice $4 balance in Apple, just back to equilibrium. And again, that's the air quotes easy part of the move, which I know is not always the easy part of the move. That's what I was talking about when we were analyzing the 5 minute chart of the spies this morning as well. It's just like, like we said in the morning game plan, I don't like off the open shorts into these large gap downs on a day three. If you're going to put shorts on, short short this shooting star on the 5 minute Apple. You get the bounce back into the ADMA, you get a shooting star. That's a signal. I didn't take that trade. I was long. If you took it, you probably would have had like a break even trade, or maybe made a few dollars, then gotten stopped out. But that's the trade you want to look for. Or the trade where that opening low does break that leads to a downtrend. Shorting off the open in a large gap down that's technically a common gap in a market that's neutral to bullish is usually not a good move. And I think that conversation helped, like Brant this morning, who was initially thinking Tesla short. And then we discussed, well, yeah, Tesla short. I certainly see the trade. You got the two inside days in a row there. So, 456.06 is a potential daily shooter and down for a break of this consolidation, a break of that most recent inside day. But do you really want to short that gap down this morning? And I think the answer to that's no. But same deal. I remember calling out, even though I wasn't in Tesla, at 9:40 this morning, hey, if anybody's in Tesla, Great spot to be selling here to book profit. Why? Because you got the, again, not necessarily easy, but we're going to call it the easy part of the move, which is the snapback to equilibrium on that small time frame. And if anything, even though I didn't call this out, you could also look for a shooting star or a doji candle. This doji is probably a little bit tricky, and this opening strength is probably a little bit tricky to come in and short. But then you could look for a shorting signal there, or you could look for a shorting signal on now on the break of the inside day low or the break of the opening low, something like that. That's going to be a much better trade, I think, with a higher probability of success and probably a better risk reward as well than just, trying to short off the open versus 445 when the gap down is as big as it is. So I was glad to see that Brant was able to beat him. I think he had to go. I don't think he's in the afternoon meeting today, but glad to see that flexibility of, us having a great team and us all providing our thought processes and being able to show a trader like, hey, maybe actually I like my idea, but I should be patient with it, let alone have the mental flexibility to flip my thought process and actually go long initially and make a few dollars on the long side. Um, so that was that. Yeah, Amazon was solid. Google was solid. I spent a lot of time focused on AI and Path today. Path was the easier trade if you were able to get stock. And I think getting stock was a little bit difficult in it. There was a good pivot here off the 80 MA. You could have tried long through 1650 versus the opening low. 30 cents risk on a $16 stock. It's a lot, honestly, but we know that Path is a growth stock. It can move. So maybe not the end of the world there. We had discussed 1650 to $17 as a spot to pay attention to in Path. The momentum on that was great. I thought the earnings report was decent, but the buyback was tremendously important. So Path was good. AI was good also. I started too early in AI, even though I was light. I announced like pre-market at some point, I think a little bit before the morning meeting or during the morning meeting, that I bought a feeler in AI, and that was like a little bit above $27 somewhere, I think. And the idea was I was looking at $25 and $28. So the idea was if I can get this trade through $28, you're back through a really key level, and maybe they buy this thing all the way back up to positive. We've certainly seen that happen. And the real reason for that thought process is, yeah, not only is $28 a level that could trigger that, but also I actually thought that the earnings report was just fine. I know the market's punishing it because they withdrew their guidance of profitability for the fourth quarter of this year, I think. I'm trying to even remember, but they withdrew that guidance of hitting profitability, and we're in an environment right now where the market craves profitability from growth companies. But if you really kind of read the fine print there, they're doing it to spend because they see big opportunities, and that's after having a really solid report that beats everything. So I actually think that when you're looking at a stock that's as expensive fundamentally as AI is, the only way that you can even justify that expense is their reinvestment for growth. So, I know that the market craves profitability and that's what they want, and they sold it back down off of that. But I actually don't think it's a bad thing that they're seeing such great opportunities in their marketplace that they would rather, as a growth company, hold off on profitability to reinvest in themselves and try to build a bigger moat. So that was kind of the thesis. And then as far as the price action goes, we said, hey, 28's a big level. Really need to trade back through 28. And I thought that that could happen. Like we've all seen it. Stock opens up down, maybe the stock opens up at 27.50 or something. I've got some stock pre-market from somewhere above $27. It trades back through $28, and the next thing you know, you're looking at the stock at 32, 33, 34, something like that. So that was one idea that I was thinking. But the other idea that I mentioned, and this is actually what happened, is you got the problem with this gap down below 28 from a technical perspective, and the technicals are the most important thing, is that every single person that has bought AI for the last 3 months is now underwater because $28 is a pretty big support level here for the stock. All these people that have bought between that $28 support level and this $49 high are now underwater. And what do people do when they're underwater? They puke out their stock. So I thought you might get some trapped sellers coming into the market early that could hit this thing back down. So the other level I mentioned was like $25 to 25 quarter, which is where the 200 day is. And that's really what played out. You can see here just that opening puke type action of trapped longs and short sellers that were just jamming this down on the offer. You could see some of those short sellers that were actually coming in. And it wasn't until this volume pickup through $26 here as we started to approach that 200 day that I actually became a lot more aggressive. And I called it out when I was on the radio. I was like, all right, I'm starting to get more aggressive on buying AI. So I bought stock in the 2550s, 2560s, 2570s, and that actually played out really well. But I was still kind of bag holding some of the feeler stock that I had bought above 27 bucks. So at the end of the day, it's my second best name, and my P&L in it is decent. But for me, Path was by far my best name, and I was also swinging some into the report, so that helps. Um, so that turned out to be a really good trade if you were patient enough and waited to that $25 area for the long. And then, it even overshot the expectations as they just squeezed out the intraday shorts and it worked its way back up to that key $28 level and pretty much held that as resistance. I decided to liquidate my position into the close. I think it closed well enough and with a good enough of a tail that if you've got stock from $26 or below, that you easily could swing this and see if it can recapture 28 tomorrow. And if it can do that, you could be looking at a pretty quick, fast gap fill. I just, I have to look at my swings in conjunction with all of the positions that I have on, and I'm 100% long still this market, generally from pretty good prices, and I'm pretty happy with how I've traded in these more difficult months of August and September. By selling positions in the way up into that 455 area where the spies kind of started the month. Um, but I'm also recognizing that with only longs on, no shorts, even as I've lightened up and I've done well, um, the market here is holding on by a thread, and it just doesn't make sense for me from a portfolio management perspective to really be adding on an additional new long position in a growth stock right now. So I decided to liquidate it. But otherwise, I think it could be a good swing, and if you got a good profit cushion, makes sense to hold some. So that is all that I've got. I am happy to answer any questions that anybody has. So scrolling up here in the VTF, first thing I'm seeing is from our buddy Rex. Question on adding back the stock that's sold at intraday extension. When you sold the stock that's extended and that stock started to do a time correction and the equilibrium started to catch up, would you add back stock you sold at the same price if the stock shows relative strength, such as Amazon today? I'm nodding my head yes. It depends on the game plan that you're implementing for the trade. And I do this on both sides of the market. This is how I also will sometimes trade counter trend, which I did at one point with a small IWM trade today that ended up being break even. Sometimes when I see that, or we could look at Qualcomm, which I know Dimitri was trying to focus on an extension trade as well at lows here, and he had really good execution on that long. Or when I tried the IWM and initially here, and then I got pushed out of it. Sometimes and I'm talking about counter trend. You're talking about more kind of with trend with strong stocks and add backs. It's probably the better way to do it. But the same concept applies. Sometimes when I'm taking these counter trend trades, my target is really the moving average, right? My target, like, or Apple yesterday, right? This long trade that I had called out at 10 a.m. yesterday, which was just off kind of extreme extension on this 5-minute chart at 10 a.m., which is a little bit late in the day to have that much 5-minute chart extension. I'm not looking for full reversals here. I'm just just a snapback trade off that extension. And ideally, what you want is as much price correction as possible, not time correction. Time correction, the moving averages move down to price. Price correction is when the price moves up to the moving average. I want price correction because price actions that the price correction is what's going to pay me. If I get time correction, I'm in a bad spot. But let's say that I entered Apple at with an average price of 184 quarter yesterday, which probably was somewhere around my average price on that trade that I took. I'm taking that trade because I could take this trade for 30 cents worth of risk or so, 35 cents worth of risk, but that 80 MA is still all the way up at 186. So the risk reward on getting a snapback just to the 80 MA, it makes a lot of sense there for that quick trade, given the layers of probability of extension and volume pickup and all the other things that we like to look at. But if I don't get a price correction, if I get a time correction, what you would see me doing if you could see my orders that I have to book profit in the trade is I'm rapidly bringing those offers kind of down because my target isn't a price target, it's an equilibrium target. But equilibrium is a moving target. So I have to adjust if I'm getting that time correction as opposed to getting the price correction that I actually want. Um, so on your kind of trade, it's pretty much the opposite situation. And I do this as well. And I don't know where you got involved, but sometimes maybe you get this really big extension and you say, oh wow, we're nice and extended here, so I'm gonna, book some profit and I'll look to rebuy when, the ADMA catches up or whatever. Well, if it really time corrects instead of price correcting, ideally you want the price correction. You sell stock, let's say at, I don't know, 138 quarter or so, 136 quarter or so at 1020 into the sub move, and then it pulls back and you're rebuying at the ADMA at 135.75, and you kind of keep the 50-cent difference and you can utilize that as cash flow. That's on the price correction. But similar to what I was just saying about the counter trend trade, except in reverse, sometimes you don't get the price correction, sometimes you get the time correction. And if your game plan says, I need to rebuy my stock when equilibrium catches up, whether it's a price correction or a time correction, if it is a time correction, it could mean that you are rebuying your stock at a very similar price in which you sold it. And that's fine if that's the game plan that you actually built for the trade. I do that for some of the game plans that I create for my trades. Other game plans, like we've talked about, I'm buying and selling more incrementally. I'm doing it every 25 cents or 50 cents or 10 cents or $1 or whatever, depending on the stock that I'm involved in which case I'm not just selling because of extension, I'm selling because my game plan said to do it more on a quantitative basis, just incrementally, and then also rebuy incrementally, and I'm not doing it really on technicals at all. Um, if that's my game plan, then I shouldn't be rebuying at the same price in which I sold. But if my game plan is to do that type of trading more technically, selling into extension and rebuying, then yeah, sometimes you kind of, stock was so strong that you end up buying at that price or potentially even a little bit higher, which that I struggle to be able to do personally. But in theory, even potentially even a little bit higher than where you sold. So great question, Rex. Like always, I appreciate it. From Dave S. Question about candlestick analysis. I've been focusing on trying to catch reversals lately. Oof, we hate that word. When trading a shooting star, the setup seems very clear to me, but I'm wondering if the same thing can be done with a doji candle, generally speaking. The answer is yes. Also, am I correct in thinking the following? It's the same thing as a shooting star, but it had an additional brief period where it went lower and found some buyers before it closed with a doji instead on a very low time frame. Yeah, so I'm gonna say very broadly, you're better off getting a shooting star or hammer doji than getting just like a spinning top doji, which is a candle that's got small body and large tails on both sides. A shooting star, if you're looking for a retracement, which is the better word than reversal, even though we always all kind of use the reversal word. If you're looking for that retracement lower off a shooting star candle, the meaning, the supply and demand dynamic meaning behind a shooting star is very clear. It is sellers came in at the high of that candle, and sellers stayed in control for the duration of that candle, and they closed it at lows. So reasonably thinking, those sellers can maintain control until some point. That point is typically the equilibrium area, with relative ease, and I can be involved in this counter trend trade with the stop loss as the high of the shooting star, and the premise is that those sellers can maintain control. If you're looking at more of like a spinning top doji with tails on both sides, it's a little bit more representative of indecision than a full-on change in buyers to sellers. So it's more like buyers have been in control, they drove it up. The doji coming in means that sellers are present, but the buyers didn't fully go away yet either. So it can mean, indecision or change, and certainly could be, like I said with Tesla, when we analyzed Tesla before, I would consider a short off this Tesla doji here to be a very valid trade. Big bounce back in a weakish market into that equilibrium area, giving you the doji, shorting versus that high. But I think that this Apple candle is even better. The Tesla candle, yeah, sellers are coming in here. They're representing themselves, and it's at an important point technically for the market. So you can come in and look for that short. Um, but buyers are still present, as opposed to Apple here. This candle says, hey, the buyers ran out of steam and sellers took control at this high and closed it more or less at that low, and I'm looking for them just to maintain that control for downside follow through at that point. So hope that helps, Dave. Great question. I appreciate it. From Ben, I've been having trouble entering trades without a clear candle to execute off of, like an inside five, hammer, ignition bar. Without a candle to execute off of, I end up never getting involved because I'm not sure when the right moment to pull the trigger is. I had this problem with DraftKings yesterday morning. I also had this problem with Google and Amazon this morning. Um, Google and Amazon. Amazon looks even more difficult than Google from an execution perspective. DraftKings yesterday just kind of going straight up. Yep. Um, my problem with going long versus the opening is that I don't know when an opening low will be created. So buying at 931, assuming the opening low is the first 30 seconds is the real opening low, has gotten me shaken out plenty of times. How would you recommend executing DraftKings trade yesterday morning or some of the tech names this morning? Sure. So that's a great question. Um, and that's why I was saying earlier in the meeting, when I was calling like this initial Amazon move to the ADMA, or this initial Apple move to the ADMA, or this initial Tesla move to the ADMA, or this SPY first 15-minute bounce. When I call that the easy money, I'm using like air quotes there, and I'm saying, I call that the easy money because it's that opening bounce off the extension from the gap, but in reality, it's not necessarily easy because it doesn't take execution in mind, and the execution could sometimes actually be very difficult in those situations, because generally you need to have an actual execution setup, right? Like we can come in and say, hey, the market is having like a day three gap down and what has been a bullish market, and it's a large, common gap to the downside. So therefore, probability dictates that the market should bounce. Well, that probability is not a trade, right? Probability is not an execution setup. Probability means that any long trade or long execution setup that you can actually find off the open will have a higher probability of success because of our gap analysis and our market analysis and our extension analysis. That's what that's saying. So that's why whenever I say like, the easy money off the open on the bounce, I don't, I know that's not necessarily easy money. It's just that this is the move that very simply fulfills our expectations, and you need to actually be able to find a way to execute that, because execution is where the actual trade comes in, right? A trade is something with a technical reason. What's my signal to buy? And it has a technical out, which is the stop loss, which is how you manage risk. That's the definition of what a trade actually is. A piece of probability is not a trade. It's a factor that affects a trade. So a lot of what we're doing pre-market, we don't necessarily know what all the trade execution setups are going to be because the market hasn't opened yet. Some of them we can identify from a daily chart, like a breakout. But others, you can't know what a you can't possibly know about this Apple shooting star until it actually occurs. This is an execution setup, right? This is an execution candle. It's a shooting star into the ADMA when the market is no longer extended in a market that is, um, you know, short term kind of bearish here. So again, now this is very clear. This is the execution setup. The trade setup is a shooting star into the ADMA. The execution is shorting because of that as the bar closes with a stop loss at highs. So that's the trade itself. Everything else, the equilibrium catch up, the broader market weakness, Apple having bad news, that is all, layers of probability. So your question is a very valid question. Is, Derrick, I still thought this market should be bouncing this morning for all the reasons that we talked about, but how and where do I actually come in and execute that? That is a, significantly more difficult thing. You really need to actually have the trade itself. So where can that trade come in? It could be, like you said, you gave me some examples of execution setups of actual trades. If I could have found an inside five that broke up, on the second bar of the day, I could have taken that. Or if I could have gotten an opening hammer, I could have bought versus that low, which you did get in Apple, by the way. Or, some sort of an ignition bar and a breakout. Those are all execution setups that you can look for. So first of all is you need to try to find something like that. Secondly is to find something on the daily chart. Like Google as an example, I think that this Google execution was very much there. The trade that I took is a little bit more of a difficult trade, I think, for newer traders. Um, 133 we know is a really big level. So you could look at this is a trade that we do a lot, right? The market breaking 133, and then you buy it back through 133 because you know it's an important daily level versus an opening low. That's an execution setup, and then the market and all those other factors are on your side. Or even after this candle closed, like, oh wow, I have a hammer. It's not quite a hammer. It's almost a hammer. There's a little bit of an upside tail. I've got like a hammer doji type candle here. If the risk reward still makes sense to go long at 133.30 versus lows versus where the ADMA is, that's also an execution setup that you can actually take. If you look at DraftKings from yesterday, that's much more difficult. This thing just kind of gaps down and goes. So unless you've got something on the daily chart, I don't see anything there. And I remember DraftKings was a trade that I had discussed in the morning meeting yesterday. And sometimes what I do is a little bit bigger picture. And I'm like, well, all I know pre-market what I'm doing this morning meeting is what the daily chart is telling me. So I like the idea of building in on DraftKings versus yesterday's low. And this goes back to being right or wrong. I know that I'm wrong on the DraftKings long idea if it breaks yesterday's low, which is a potential pivot point, a potential higher low in this uptrend off that equilibrium on a retest of this $29 area. So I can look to build in versus yesterday's low. So if you're looking at DraftKings yesterday, your only real choice was to buy real small versus this low if that risk reward makes sense. And you could very easily argue that that risk reward does not make sense, in which case then you don't take the trade. But otherwise, I see no real way to actually execute DraftKings. For Amazon today, also, a little bit tricky. We know like this 137, 137.50 is a really important level on the upside. We know like 130 is really important on the downside. This thing kind of opened up a little bit in no man's land on the daily chart. So, it's difficult. What you're saying about buying versus an opening low, I get, but it's also a tricky trade, especially if you're trying to do it after 30 seconds. Um, I do like and I do talk about going long versus the opening low on these big gap downs, right? I remember specifically that was my big game plan for the August 18th low. I was like, the opening low could happen in the first 5 minutes, or maybe we see selling for the first 15 minutes and then we get a pivot low and it goes. So let me wait and establish the opening low. And then I remember we could see, 3, 4 minutes into the day when the market was ripping on the first bar. All right, that looks like it's the opening low. So you can just try to buy things on the way up versus what that opening low is in those first few minutes. Sometimes within the first 1 minute is difficult because there's so much volatility there that it's very easy to get shaken out. But I remember, what I did on the August 18th low was that like my focus was ARK. ARK had an opening uptick of like 48 or 49 cents, something like that. The opening low was 39.32. So I just put a buy stop and I communicated it. Hey, everybody, got a buy stop at 39.51. And if that buy stop triggers, I know I'm buying on the way up after this low has been established at 32.32, sorry, at 39.32, and then that's going to be my trade, that's going to be my stop loss, and I'm buying versus what I see as a potential opening low. You can always get chicken out of those trades. So you want to be able to balance confirmation with not being too late, right? Because sometimes if you wait 8 minutes, all right, the market's bouncing, I got my confirmation. Well, you've already given down your full price control up to that point. You've got no risk reward to go long versus. If you're doing it after 30 seconds, there's so much volatility still. You got a quick opening low that happened within the first 30 seconds. You can very easily get chicken out. You need to have some sort of balance there where, again, sometimes it's easier if you get the selling for the first 15 minutes and then you get the hammer low and we get that 5-minute RDR trade that I've been communicating and trading a lot recently on the third or fourth 5-minute bar of the day for the index. That's a great execution setup for kind of what we're talking about with these gap downs, because again, sometimes on these gap downs they do buy it up immediately as soon as the market opens. Sometimes on these gap downs you get panic selling for 10-15 minutes that makes a market that's extended from the gap even more extended, and then you actually get that 5-minute RDR or 5-minute doji that comes in that you can look to execute on the way up. That's the probably easier trade in some regards. But again, we don't get it. And I personally sometimes I like that, like, second the market opens on the gap down, they're buying that thing immediately back up. I like that, but I know it can make for a much more difficult execution. So, I guess to sum up your excellent question, because it is an excellent question, um, you you we are digesting and focusing on all of these layers of probability as much as we possibly can that are factors for market expectations. But then we actually need the execution setup, also known as the trade, to be able to enter and know how and why we're entering and how we're managing risk and where our stop loss actually will be on the trade. And sometimes that can be a little bit more difficult. There are a lot of examples of trade types: inside five, hammer or shooting star, ignition bar. We talked about how to potentially buy off of an opening low a little bit here in answer to your question as well. And the final thing I would answer with is that sometimes you just don't get it. You analyze the probability of an opening bounce like we did today, and the execution setup never comes to play, and you don't get your trade, and the market goes up without you. And I think that that's actually totally fine. Um, the market doesn't always work perfectly in the exact manner that we want it to work, right? And if you don't have an actual trade, you shouldn't trade. And we need to remember that information is not a trade. A, a piece of probability is not a trade. The market is strong is not a trade. This stock has relative strength is not a trade. Um, the fact that there's news is not a trade. Uh, those are all pieces of information that affect the probability on the trades that you actually find working. So again, fantastic question there, Ben. Appreciate it. Um, Fernando, to analyze swing trades, do you use indicators or just candles and moving averages? So I primarily focus on. Um, I don't use a ton of indicators. So I'm primarily focused on Japanese candlesticks in conjunction with their volume profile, and I use a couple key moving averages that are really important to me. I am not against indicators. I just think it's important that people need to remember that all indicators do is indicate something. They're not trades in and of to themselves. And I think that some people become overly reliant on indicators. I think that indicators, going back to the conversation we just had off of Ben's question, indicators are like layers of probability. I know that they're trades and they're pieces of information. So you want to find your actual trade, and then any indicators that you find could be a piece of information that affects that trade. And even though I don't have indicators on my charts, I pay attention to them. So we get Tate in here, giving us DeMark indicators all the time. That's very helpful. We've got a few people like Pat and a couple others, Cody, providing RSI. on an intraday basis when we're looking at extension trades. I don't have that on my charts, but I find it very helpful when the team is able to communicate that to me. If you read Pat's morning note, which I highly recommend that you read Pat's morning note, if you look at his technical analysis portion of his morning note, he looks at Bollinger Bands. He looks at different moving averages that I do. He looks at Ichimoto clouds. I'm probably never going to put any of that stuff on my personal charts, but you better believe I pay attention to Pat's analysis when he communicates where we are with certain things. Or the oscillator. I don't have access to the oscillator, but when Josh or Chris can provide it, like I remember Josh and Chris providing the oscillator numbers into these down moves here on August 17th and 18th. That was another piece of information that gave me higher conviction for the big buying that we looked to do as a team on August 18th on the gap down. So yeah, appreciate the question, Fernando. I don't have any books that are specifically gauged towards swing trading that I can recommend to you. Maybe somebody else on the team does. Um, I can, always go over my swing trading rules. I think that technical analysis is a thing that's the same on almost any time frame that you look at. So if you're looking at technical analysis on a 5 minute chart for day trading or on a daily chart for swing trading, I think it's the same thing. So you can read a technical analysis book and apply it to any time frame. A lot of what I like to do is trade small time frames in the direction of big time frames. I remember, Fernando, you asked about, I think it was DT yesterday, about going long, versus one of these daily chart lows, 45.32, something like that. Yeah, you can absolutely do that on a swing basis. I don't like the risk reward of doing that though. The chart looks great, I think, as it works its way up into the gap if we can get above $49. And certainly on a very big picture, 43, 45, 30 is a really important support level, and you don't want stock getting below that. So if you were just a pure swing trader, that's a swing trading stop loss. What I want to do is take this daily chart picture, recognize that this stock starts looking really good above $49, or recognize that it's trading really well yesterday and showing really good relative strength yesterday, and use the big time frame as a reward profile, but find a small time frame for entry. Find something on that 5 minute chart or on the 15 minute chart to actually be able to execute the long off of, but look for the daily chart reward. So if you're buying it yesterday and it closes well, you swing some, and then it closes well again today, and you keep that swing, and it breaks through 49. You're it's always in your favor, as opposed to if you're just buying it, $48 versus 43.50, you're taking on, sorry, versus 45.50 or whatever. You're taking on, two and a half, $3 worth of risk, which is called $3 worth of risk. What do you need this thing to do in order to be worth it on a risk reward perspective? You need this thing to go back to $56, or it wasn't worth the risk that you put on. And that's a big move that you need just to make the trade even worth it. But what if you could find a small time frame execution somewhere in here where you are, instead of risking, $3 on it, you are risking 30, 50, 60 cents on it, but you still have the same reward profile of, hey, if this can clear through 49, it works its way up into the gap. If it gets up to $53, now all of a sudden, instead of risking $3 down to $45, and at, $53 at a gap fill point here, which is a pretty big move, you're, what is it, $5 in the money. It's not even 2 to 1. Now all of a sudden you found that 30 cents risk spot and you're $5 in the money. And you're never really sitting in positions that are against you, because we always want to think about the worst case scenario. What if, all right, I'm buying this thing. I think the daily chart looks good. I'm giving it down to 43, 45, 30. It's at $46. It's bleeding against me. It hasn't got my stop yet, but now I'm negative in it. And then maybe it has bad news and it gaps down to 43 because bad news happens. We saw that for anybody who might have been swinging Apple the last couple of days. And now all of a sudden you're in a really rough spot. I'm trying to always trade from these win-win situations as much as possible. So great question, Fernando. I appreciate it. Let's pop over to the YouTube and see if there's any questions in there. What's up, Robert? Yesterday, E&B news. What was your thought process in the stock? I didn't follow E&B at all yesterday. Um, I didn't follow E&B at all yesterday. I don't know what that news even was. It looks like it was an earnings report. What's your thought process in the stock? Making deals and companies gapping down. I was trading long yesterday. I did not hold any for a swing. Do you have any general guidance or playbook for that type of catalyst? So again, I don't know what the news was, Robert. So I'm handcuffed and really giving you any feedback on a thought process for the stock. Again, I assume that it was earnings. Maybe here it goes. Enridge shares are trading lower after the company entered agreements with Dominion Energy to acquire EOG, Questar, and PSNC for an aggregate purchase price of $14 billion. Um, so they're the acquirer, right? So they're acquiring this other company. So that we very regularly see stocks get hit on that. Sometimes the market makes a mistake on it. So for me, so I guess to directly answer your question, I don't have strict rules on this, right? Sometimes the market punishes companies for buying another company, and that's because the market decides that, hey, you're using way too much cash, you're buying this company at way too expensive of a price, and it's not going to be accretive enough for your earnings reports. In other circumstances, I remember when Microsoft bought LinkedIn, and Microsoft gapped down really big when they bought LinkedIn, which used to be a publicly traded company. I remember trading the IPO of LinkedIn, and Microsoft gapped down really big on it because the market decided that they didn't like the price that Microsoft was paying. And I was like, and I disagreed with the market, and this goes back to more of a fundamental thesis. I was like, LinkedIn's going to be the data that Microsoft is going to be able to gather off LinkedIn is going to be huge. This is their entry into social media, but it's a little bit different. It's not direct competition with like a Facebook. I loved it. I loved it. So I was looking for execution setups all morning that day to get long Microsoft, and it worked great. Um, so I really think that that's on a case by case basis, and I think that you have to have a good understanding of the companies that are involved and the prices that are being paid. And in the case of the companies here, ENB, EOG, I just don't know the companies well enough to have any real thought process or thesis on it. I've seen it where companies get battered and bruised and punished because they're doing it. I've seen other circumstances where the market loves the deal and they buy it back up. So I don't really have any good general rules for you. I think each circumstance there is unique. Appreciate the question, Robert. Give me that thumbs up button. Uh, and I'm seeing Cameron here also saying that ENB has to issue more stock to fund the transaction as well. That's bad. That's now objectively bad, right? Secondary offerings. I mean, look, this is again going back to market dynamics, which our market dynamic situation is becoming more and more complex. It feels like over the years, or maybe I'm just understanding it and knowing it better and understanding how complicated it is when we're looking at the VIX and systematic strategies and dealer hedging and now zero DTE and all this stuff. One of the easiest concepts to understand about market dynamics is buybacks and secondary offerings. Buybacks are good, secondary offerings are bad. It's supply and demand. It's supply and demand. What is a buyback? A buyback is forced demand from the company itself. What is a secondary? A secondary is forced supply from the company itself. So everything else held equal, which again is never a term that we really should use in trading, but we have to sometimes just understand concepts. Buybacks are going to make your stocks go up. Secondaries are going to make your stocks go down. Because with the secondary offering as an example, if the same amount of people want to own that company, but now there's a bunch more stock, you have a supply and demand imbalance and the stock is going down. In a buyback situation, if the same amount of people want to own that company, but now there's going to be less supply and the company itself will be consistently on the bid over the course of the next quarter or year, that is a supply and demand balance in favor of the bulls. And that's why I always say that Apple is super difficult to short. Doesn't mean you can't short it. We saw Apple go down a lot in 2022, but it's super difficult to short. They're buying back $25 billion of their stock per quarter. It's an insane number. And a recent example that I used is for Coursera. Coursera trades thin, so the company being on its own bid can have a big effect on the stock. It trades pretty thin. There was a period of time here where it was doing a million shares or under pretty consistently. I think that's improved a little bit, but this Coursera is one of the best looking stocks that you can find in the market right now from a charting perspective. Look at the pullback in Coursera as the market pulled back in August and September. Look at it. You can't find it. It's not there. They announced their buyback, back here on April 28th, and the entire composure of the stock has changed ever since. It's part of the reason why I liked Path so much today. Path report was fine. It wasn't bad. It wasn't good. Initially, the market was disappointed by it and immediately sold Path down. Then the buyback news hit and they bought it back up. They're committing to buying back $500 million worth of stock in a $9 billion market cap company. That's a large percentage of the market cap that the company itself is going to buy. It creates that supply and demand imbalance. Or look at AMC yesterday. This, man, this AMC, those poor Wall Street bets people that were like, yeah, AMC, it's the best, and we're gonna, squeeze the hedge funds out of it. You know, Forget the hedge funds for a minute. If you're like an AMC Wall Street bets person, you need to be pissed at AMC management. AMC management screwed you if you're, one of these people that's trying to short squeeze the hedge funds at AMC. Management just completely screwed you on this. I think I'm allowed to say screwed, right? That's not a compliance violation? Um, that ape fiasco and then remerging it with AMC massively increased the flow. And then out of nowhere, on top of that, they do a huge secondary offering yesterday, and that's after and this was pretty smart for management, though it also screwed over those people. They announced the secondary at the top up here, which that's exactly what they should do if they're a company that needs to raise capital. But if they were trying, they're, hey, we're gonna give, free popcorn to the people that own our stock, right? Like, we appreciate you Wall Street bets people so much. You guys rock. Well, if they did that, they wouldn't be, issuing a secondary to stop the short squeeze. The management themselves, and I'm very thankful that they did it because I was short the stock. Management themselves stopped the AMC short squeeze. And I feel like that's lost on most of these Wall Street bets people that don't know anything about how markets actually work. Management is what stopped the short squeeze, not the hedgies. Management at High said, "Hey, we're gonna do a secondary and raise money because thank you. You just increased the value of our company so much that we're gonna use it as an opportunity to actually raise capital." And that makes a lot of sense, though, to me at least. But now at these prices to do another secondary, I mean, wow, just ruthlessly destroying those Wall Street bets people. I mean, that's what they need to be pissed at. Anyway, Fernando asking if my morning's position list that I publish is for intraday. No, no. Most of what I post there is based on daily charts. So it's probably, if anything, more gauged towards big picture trading than small picture trading. But I would circle back to what I said to you earlier, which is that a lot of what I'm trying to do is find intraday risk for daily chart reward. So a lot of what I do is I find these important spots on the daily charts. Again, Google 133. That's an important spot on a daily chart. So you could be looking to go long Google 133 and you want that to be a swing trade. But I'll tell you, if you're buying Google at 133 and it closed at 132, you probably shouldn't be keeping that position as a swing trade because it's closing against you. And you probably should have gotten stopped out even sooner intraday on it because the trade just wasn't working. So I'm going to look for the small time frame risk and the small time frame execution for the daily chart reward. Because the flip side is if you got Google at 133 today and it closed well and the market can also begin to recover, this Google low today could be a low that works the stock up to 150 bucks. And you bought off of today's report or whatever that I post, those alerts, and you still have stock at $150. So ideally, I want those to be swing trades, but I'm still going to execute off the small time frame because I think that small time frame execution for daily chart reward is just simply grants an overall better risk reward. No problem. Um, Again, looks like I got through everything on the VTF. Cool, we got through everything on the YouTube. Again, if you're in that YouTube, or even if you're just in the VTF and you want to pop in the YouTube link and you can give that a thumbs up, I appreciate the extra views and thumbs and all that good stuff. Whoops, I didn't mean to post that twice. Um, Question: why some traders on FinTwits say we should short bonds when the Fed is done hiking? I don't know what FinTwits is, and I don't know why those traders are saying that. Um, oh, Twitter, got it. I don't know. I can't tell you the thought process behind what traders are posting on Twitter. There's a lot of information. There's a lot of noise on there. I mean, one argument there's arguments that you could make that bonds can still go down even when the Fed is done hiking, and that's just more off of supply and demand. Because even if the Fed is done hiking, they're not going to be done reducing their balance sheet, and at the same time, the U.S. government is not going to be done issuing bonds. So, I think that if the Fed stops hiking, on the surface of it, um, you might get a bounce. The thought process might be that you get a bounce in bonds and interest rates move down a little bit. But the other way that you could look at it is that it just becomes more of a supply and demand thing broadly. And you could still have um, bonds go down and interest rates go up just because there is more selling than buying in bonds. Uh, it's just interesting. It's just interesting to wonder if at a certain point, and we've been saying this for like a while now, and it hasn't fully played out, where people just say, hey, I can get, 5+% on a risk free bond. I would rather have that than all the volatility of the stock market. And then they buy it, which then in turn causes interest rates to actually go down a little bit. It's the other side of supply and demand. So, yeah, we'll see. All right, gang. 5:20. I gotta catch a train back to Long Island. I'm gonna work from Long Island tomorrow, and then I got a wedding after hours tomorrow. So I gotta get out of here. Have a great night. See you all then.